All right. Good morning, everyone. My name is Edward Maldonado. I serve as the treasurer of Shekumaku Iraqi American Association, and I'm also the owner of a small business that I started called Omega Financial Management Solutions LLC. I provide uh, accounting, tax, and consulting services for individuals, small businesses, not quite CPA firm, attestation type services, but we're working towards that eventually. Today, I'm here to provide a presentation on the overview of U.S. system of taxation. Here in the United States, there's a very complex system of taxes that are assessed at really all levels of government, from the federal level down to the state, county, city. There's a slew of taxes. The focus of today's presentation will be primarily on federal taxation and income tax, being that this is basically the income tax filing season. So by the end of this session, you'll be able to understand the purpose and importance of taxation, comprehend the foundations of taxation, identify types of taxes in the US, or at least some of them, understand or explain tax compliance and administration, recognize some tax law sources and professional standards, understand the individual income tax framework, learn income recognition and exclusions. We'll talk a little bit about that. And then also just be familiar with the 2025 federal income tax brackets. I'm going to hold there for just 1 minute because I know that some of this is translated on the side there in Arabic, so that way viewers might be seeing this later at some point can take a look at those. All right. Purpose and importance of taxation. So it's important to understand taxes because whether we realize it or not, they can have an impact on our everyday lives. And especially if you own a business or someday think of owning a business, you'll want to understand this as well, because the concepts that we'll be discussing here today could be valuable to you to understand, at least on a basic level. So that way, because taxes will impact those business decisions. For example, like things like selling a home. Some people may not realize it, or maybe may not be aware, but selling your personal home, there are certain tax advantages to waiting a certain amount of time, as opposed, so that way you can get a tax benefit from being able to exclude some of the proceeds from the sale of that home. Also, it's just good to understand overall tax compliance and savings, because ultimately you are responsible for your taxes. Once you file your taxes, some people may, attempt to do it on their own using one of the softwares or apps available out there, or might walk into a Walmart or one of the other brick and mortar type places and pay someone with one of the businesses that are common, franchises that are common throughout the US to prepare your taxes. A lot of those people that are bookkeepers, or they might have some accounting, some awareness of accounting, but oftentimes they might lack like the specialized training that, say, a CPA might have. So I just want to talk about a couple of quick, just basic concepts. What's a tax? Definition of a tax: it's a mandatory payment. So it's not something that's optional, it's mandatory. And it's imposed by government, and you're not going to be the direct recipient of any benefit from it. You might benefit from some of the federal programs, but there's not like a direct one-to-one relationship. Only government entities can impose a tax. So if you are a homeowner, look at a tax bill, you'll see maybe a tax that appears from independent school districts, or community college districts, excuse me. Those are all basically government entities in one way or the other, and those taxes are mandatory. They're not optional. Real quick about flat versus progressive tax rates. So the distinction here is that a flat tax, it's applied as a single percentage rate. Like the percentage doesn't change. An example of this would be like sales tax here in the state of Texas. In the state of Texas, we are assessed on things that we buy an 8.25% sales tax. 6.25% of that goes to the state of Texas. The 2% usually goes to one of the local entities that's assessing the tax. But that amount doesn't change at all. I mean, the percentage, it just stays flat. From whether you're buying something of $100, $1,000, whatever, it's assessed at that same percentage all the way throughout. People will often refer to that as a regressive tax, just real quick, because it has more significant impact on people of like lower income, meaning because it's more of a burden basically on people that are maybe at the more middle and lower kind of income tiers within the society. Just because everyone has to buy food, buy groceries, and buy cars and other things. And so those sales tax, since they're kind of assessed pretty much the same across the board, then it ends up being that it has a more of an impact financially on people that are the people that are less affluent as opposed to the people that are more rich and affluent. In Texas, we're one of the few states that is primarily funded by a sales tax, a state sales tax. We do not have an income tax. Other states have income taxes, like California, Colorado, New York. A lot of those states have income taxes, but they might have, and they might have sales taxes as well. Some states don't have sales taxes. Oregon doesn't have a sales tax. So you kind of find a mixed kind of bag of different taxing structures throughout the U.S. So it's good to kind of be aware of that, because if you happen to move from one state to another, things might be different in the new state as opposed to how they operated in the old state. And there's even some cities that have taxes as well, income taxes. But here in Texas currently, we don't have an income tax. We're funded primarily through sales tax and heavily through property tax. We have some of the highest property tax rates in the country, I believe. That would be more of a flat tax, because it's the percentage doesn't change. Like if your property's worth more, you're not having to pay a higher percentage. Whereas, so when they implemented the income tax system way back, probably going on like 100 years ago, they constructed it in a way where it was progressive. What that means is, as you earn, and I'm gonna have a visual in a minute, you're gonna kind of see what that looks like. But as you earn more money, you move through to the different tax brackets. So just a pop quiz, if anyone wants to take a guess. When it comes to individuals, how many tax brackets are there? Yes? No? 3? It's a good. I'm about to, no, I'm not sure you know. This is just a quiz. I'm just quizzing folks to see. Close. It's 7. Yeah, see, if nothing else, you learned something today. All right, hey, job accomplished. No, there's 7 tax brackets. Now, as you earn more income, you move from one bracket to the next. I'll show you in a minute, but everyone starts, every dollar when we start working, you start off at the first tier or bottom tier, which is at 10%, and it moves through there on the way up. It's important to kind of somewhat be aware of that, because that knowledge will help you to be a little bit more strategic Because if you're like on the cusp of where you have some money or you have some potential income, that if you receive it before the year's over, like, you know, then, and it might push you to the next tax bracket. And whereas if you maybe delay it a little bit to the next year, say you're about to, I'm just gonna say you're a salesperson, you're making big sales or you're negotiating, doing service, whatever. You're selling Glacia and Iraqi chai, and you have the potential to kind of close a big sale. It's like, let's say it's December 25th. You have a big sale you can close. You're gonna sell $500,000 more of Glacia and tea. Well, if you sell it before the year's over, you're gonna have to include that whole $500,000 or amount in your income. Whereas if you delay it to the next year, so after January 1st, then you might start at a lower tier and you're able to kind of plan things a little bit and have some control. Tax avoidance is legal, meaning is legal. That's it, right? Okay, hold on. I'm gonna say it one more time. Tax avoidance is legal. That's where you can be strategic and kind of like conduct business or your personal affairs in a way in which you're able to kind of delay or maybe perhaps even advance the recognition and earning an income so that you can derive some kind of maybe a little bit, pay less in taxes basically. But tax evasion is illegal. That's where you're generating money and just like hiding it or whatever and then not paying taxes. So if doing things, small things like delaying sales or some of these other strategies can help you in a legal way to basically minimize your tax burden. And then again, just want to emphasize, that's kind of what I'm talking about there, like these tax structures, these various factors can influence your behavior, whether that's on an individual basis or in the future or now on a business basis, if you're either own a business or thinking of owning a business. Sure. 8.25, yep. No, so sales tax, it doesn't necessarily apply on every single thing you buy. Like there's not a sales tax for buying your home. And even some of if you look at a grocery store receipt, you go to H-E-B, you buy some groceries, some of the what they consider like staple items, like very like fundamental things, that very basic things that pretty much every family kind of needs to eat and live to survive, or like milk. I want to say milk. I don't have a list, but milk. Like if you go to the H-E-B right now, you buy milk, cheese, eggs, those three things. It's possible you might not see any sales tax in that receipt. So some of the things, even some of like the core things that we buy are like excluded from sales tax. And so the sales tax isn't assessed on everything. It's more like on goods, like consumer goods or cars. You go to Best Buy and buy an iPhone or laptop or something like that. But it's not really like on a home. It's not assessed on home. There's other taxes and things involved with buying or maintaining a home, but sales tax isn't really one of them. Yeah, good question. So some of the federal tax types, there's income tax, which we are responsible for as individuals in our income taxes. You don't share that burden with an employer or anyone else. And that's pretty much going to be the focus of what we kind of walk through here in a moment in more detail. There's also employment taxes. So when you work as an employee, and I'll make a distinction here in a minute, when you work as an employee or really when you just work in general, you're paying not just income tax. You're responsible not just for income tax, but you will also be responsible in our assessed employment taxes. Now, what does that mean? That's really comprised of big programs in the U.S., which are Social Security, which is Social Security. I won't get into all the complexities of it, but it is a kind of a safety net for, I guess one of the primary targets is more like older individuals, kind of like acting like sort of like a pension or some kind of retirement fund that some seniors receive like a check each month. There's also some other aspects of it that kind of help with disability. But the core of what Social Security covers is more like a monthly check or benefit to senior citizens once they stop working. Currently, Social Security exists, but you'll often hear in the news that it's always at risk of maybe going away because it's not fully funded. And so they've been saying now, I think pretty much as long as I can remember, that Social Security is always kind of at risk of like going broke or going bankrupt. But for right now, those that receive Social Security do receive like a monthly check each month. If you qualify, you have to work as like a certain number of orders and to be able to kind of qualify for those benefits. That's not the focus of right now, but just be aware that if you're working, you're paying into Social Security. And then another type of employment tax is Medicare, which is like a government funded kind of type of like health insurance, essentially. Again, primarily targeted towards senior citizens. There's different components of that, which are like health care, there's hospital care, there's prescription drug care. So the other employment taxes that you're paying from each check are going to fund Social Security and Medicare. There's something called excise taxes. Those are basically taxes that are assessed on like specific things that, well, the government just decides to go ahead and tax because I guess they realize that people are going to buy them regardless, which are like alcohol, tobacco, gasoline. So some of those things people will buy them. So that's a source of revenue also for the government. Transfer taxes, that has to do like with transferring of like wealth and estates and inheritance. And there's unemployment taxes. Now that's paid more like by the employer. They're paying into like an unemployment fund to kind of help support those who might need to tap into some unemployment benefits if they're laid off from a job or something like that. A lot of these are the responsibility is kind of split up between different kind of people or parties. Like going back to employment tax real quick, I'm gonna make a quick distinction. When you work for someone else as an employee, like let's say you work here at this Amplified Credit Union, you're an employee, your employer will cover half of those employment taxes. Those Social Security and Medicare tax, the employee will pay half of the percentage for those, and then the employer will cover the other half. But when you have a company or you're self-employed, you are responsible for the entire amount. It ends up being, gosh, I want to say, don't quote me, 15.2%. Because it's so half of it's like 7.45%. I don't have the percentages memorized. So when you work for someone else, you're only paying about 7-ish%. The employer covers the other 7-ish%. But when you work for yourself, you're responsible for paying income tax as well as the self-employment tax. But when people refer to self-employment tax, it's just the entire Social Security and Medicare tax all bundled together. One more thing, because we can go on and on about this. If you're a high income earner, some people aren't fully aware of this, but if you're crossed this threshold, it's like 200,000. And the reason I don't have these numbers memorized, by the way, is because they change each year to year, okay, based on inflation. So like numbers I'm about to show you in a minute for 25, they're going to change for 26. So if I'm like struggling to remembering the precise numbers because the numbers change constantly. But if you're a high income earner, like up in that 200, 300 or whatever range, there's something called like additional Medicare tax that people pay for. It's an additional 1.45% of your income. Now, at a certain level also though, you reach a point to an income where you no longer pay the Social Security tax. So it kind of like goes up, right? As you're paying Social Security tax, you reach a point in that high income field where you are kind of maxed out for the year Social Security tax. But then in Medicare tax, it just goes on and on and on. So if you were earning $500,000, then there's a part of your income where you'll be paying an extra 1.45% in additional Medicare tax that the government goes in and takes from you.
This way they can say like invest or like saving more money on 401k, for example, to avoid more tax, something like that.
Yes, yes. So, and I'm gonna repeat the questions because I realize that people might watching this later might not fully hear what the question is. So I'm sorry about that. Or the question is, like, regarding the tax brackets is, if I understand correctly, like, is one way to kind of strategize and avoid higher taxes is to like through contributing to your 401k. Yeah, there. Yes, that is. Yes, that is a way in which you can kind of shield or protect your income from maybe moving to the next bracket. Things like contributing to a 401k, a retirement account. Um, State and local taxes, again, we talked about this. It varies. But there's some states, there's some cities or localities that charge income tax. Sales tax varies throughout this, country. Some have higher sales tax, some have lower, some have none. There's use tax, property taxes. Those also, just be aware of the fact, and you might want to look at this before you move somewhere, like to another state, another city. You might want to see like, what are the taxes in that area, even like in the same city, but maybe different counties. Like Austin, for example, there's parts of Austin that are in Travis County, which is probably the majority of Austin. There's parts that are in Williamson County. If you really want to like get down into the details of it, you can kind of take a look at, and all that stuff should be publicly available if you search for it online. You can look to see like, oh, if I'm like on this side of the street in Travis County, my taxes will be higher, property tax will be higher or lower, as opposed like if I'm across the street in Williamson County. You can kind of do that kind of comparison if you're, inclined to kind of want to know exactly like the distinction between the two, because it can make a difference in maybe your monthly payment or those kinds of things. And that's kind of what I was speaking to a moment ago. Just understanding those differences and complexities will help you as an individual be more informed and understand kind of like the different costs or burdens across different jurisdictions, cities, counties, etc. Next thing I'm going to show you now, these are those 7 federal income tax brackets. So I'll let you take a look at that for a minute. It starts at 10%, and then it moves up to 12%. And then you have a big jump from 12% to 22%. And from there goes to 24%. Then it's like another big jump, it seems like, up to 32%, 35%, and you finally get to the highest bracket, which is 37%. So as you look through the rows, you'll see those different kind of percentages and brackets. Those are the 7. If you look at the columns up there, those are like the different tax filing statuses. So there's really 5 of them, but we've got kind of 2 of them kind of combined together. I'll talk about that in a minute. Single filers. And I'm gonna kind of talk about what that would be, or who that would be. A single filer is just that, one person. They don't have a spouse, they don't have any kids, or dependents, I should say. They're just a single person, and so they're on that far left column. Now, if you look at, as you're moving through those rows and you kind of glance at them, you'll see that the jump from 10% to 12% for a single filer happens quicker or sooner than if you're like a head of household. So a single filer, once they go from earning 11,925 for the year to that the next check now I've earned over the 11,926, they're at 12%. But the person that's a head of household, I'll explain what that is in a minute, won't make that jump from 10 to 12 until they're at the $17,000 income threshold. All right. So essentially, single filers end up, if you're a high income earner, end up kind of paying more often in income tax than than some of the counterparts in the other filing statuses. Head of household. A head of household is an individual, a single person. You don't have a husband, you don't have a spouse, and you have what they call like a qualifying dependent. I said a minute ago like a child, but you can have someone that's a dependent that's not your child. You can have a parent that's dependent. You can have a niece or nephew or grandchild or as a dependent. Some of those, depending on the relationship there, they could qualify as child or not. That's a little complex to kind of walk through, but just understand this. Your child, if you have a dependent that can be claimed as a child, they can continue to be claimed as your child until the year, as long as they are, the IRS words things in a strange way. I'm sure there's a reason for it, but they say while they're under the age of 19. But what that really means is like as long as they're 18. I don't know why they say it that way. That's how they say it. So the year in which your child turns 18, let's say your child's going to turn 18 this year, 2026. So when you do your taxes for this year, this will be the last year that you can claim your child as your child like dependent, and you might get, so actually I won't go into that just a minute. Sorry. I was gonna talk about child tax credit, but never mind. Table that for now. They'll stay your child until they're 18, unless they are a full-time student, like in a college or university or some type of program that's for them to acquire some type of trade, diploma, something like that. Then they can stay on your return until while they're under the age of 24, which means 23. One of the biggest distinctions or factors that needs to be considered or one should be aware of when it comes to like kind of comparing or thinking about a child dependent versus just a qualifying relative is that when it's your child or someone that qualifies as your child, there's certain tests that they apply, like relationship, where the child lives, etc. But income is not one of them. Meaning, what that means is, let's say you have a child that's a full-time student in college, and they're also working, and they make a pretty decent amount working for the year. Let's say they make $25,000-$30,000. They can still be your dependent, even though they've made 25, 30, whatever $1,000. There's like no income restriction or limit, as long as you, the parent, or the person claiming this dependent, this child, provide more than 50% of their support. Okay. But when it comes to someone that's just your qualifying relative, meaning they're not your child, or they might be a child, they might be your child, but child that's over the age of 23, or whatever, right? There is an income limit. It changes every year, but the limit's about 5,000 or so. So if you have someone, let's just say you have a child, they've graduated college, they haven't maybe started working yet, but they did work a little bit and they made, I don't know, $8,000. If they've already exceeded the age limit that where they can be claimed as your child, then that income now becomes a factor and it's too high maybe for them to even be your qualifying dependent. And what that can have an impact, because then if you have no dependents that you can claim, meaning you don't have a child you can put down, you don't have a qualifying relative that you can put down as your dependent or parent, then that might change you from being able to be head of household now to just being single. In which case now you have to pay probably more in taxes. And is there like a movement thing? Okay, cool. Real quick about parents in the US. Whether it's a child or a qualifying relative, they have to live with you to be your dependent. Now, unless it's a child, like it's away at school or something like that, where there's some kind of illness, just kind of extenuating circumstance. But if it's your parent, that's the one kind of relationship that they don't have to live with you to be your dependent. So if you have a parent, you're helping pay for more than 50% of their kind of support and expenses, and they don't live with you, they can still possibly be your dependent. And a kind of unusual thing too, it's a little bit different, is that there's certain circumstances where you can be in the US and your parent, if they're in Mexico or Canada, can be your dependent on your return. Only Mexico and Canada though. If they live down in, I don't know, Argentina or somewhere else, then that you don't have that benefit of being able to claim them on your return. But that's head of household. Okay. Married filing jointly. This is people that are married. Makes sense, right? It's pretty kind of self-explanatory. You're married, you file together. What that means is you combine all your income together, you combine all your deductions together, everything into one return. And you file together, and then y'all combined get this well, for 2025 it would have been this $23,850 sorry, I'm jumping over to deduction, sorry. That means that it wouldn't be until you surpass this 23,850 in income, it wouldn't be until you pass that you would move from the 10% to the 12%. So again, if you notice, look at this slide here, you'll see that those numbers go increasing for these first three columns because there's benefits of like to being married in some from a tax perspective. For some households, they might end up paying a little bit less than the single filers. Let's look at that for a second. Surviving spouse. What that is if you're married and your spouse passes away during the year, you can still file as married for that year, as long as you don't remarry. And you can still kind of, your income won't be taxed, you know, at the next bracket until you can still kind of move along this column here, where you have to earn like a lot more before you move from the 10 to 12 to 22, you know, kind of move through those different tiers. And then if you are a widow or widower, for 2 years after your spouse passes away, as long as you don't remarry, and if you have like a qualifying dependent, like a small child or someone you take care of, you get to file like as a qualified widow or widower and still kind of stay in this column here, which can have some tax benefits to it because then you end up paying less in income tax. Married filing separately, that's basically this is what it sounds like. You're married, but you're going to do separate returns. If you there's some people sometimes have there's a misconception that people think, oh, I heard that if I file separately that I'll get like a bigger refund or return or whatever. That's not always the case. It's actually quite unusual, and that I wouldn't recommend that as being like a primary motivation for someone to kind of file separate versus filing joint, because really they have it structured in a way to where you likely won't get any extra money doing it that way. And depending on if you're paying someone to prepare your taxes, you'll just end up probably paying double because you're gonna have to have two different returns. There's not the reason why one would do that. The reasons for one would want to do that is more about you, for whatever reason, want to maintain a separate tax liability from your spouse. Because when you file together, let's say a couple files together, married, like last year or whatever, and then they owe taxes from the previous year, and then they divorce in this year. Let's pretend like they're making payments on the tax debt from the previous year, right? Well, and then they split up, they get divorced or whatever. That tax debt still follows both spouses. You can't just say, "Oh, IRS will basically still come after you," even if it was really your spouse that made the money and owed the income tax or whatever. It's going to be like a debt that you're also be liable for. But if you do separate filings, then you're able to kind of separate those liabilities between spouse A and spouse B. In most cases, like over like 90-95% of the cases, yes. There are rare circumstances where you might get slightly more. Or there's even cases where you might actually owe or receive slightly less, but they're unusual. They're not common. And the IRS has structured things in a way to kind of ensure that that doesn't happen.
So what is either way is getting this when they're giving this option of filing separate? Because there is also some kind of misconception that if you file like separately, it has some kind of benefits.
Yeah, that's what I think. So the question is like, why is there this option? Because there is a misconception about that if people file separately, they'll get more. That's very rare, and it's actually the reason that's an option is only because it would only allow, the only reason why one would want that option is because for some whatever reason, there's some couples. Okay, I'm sorry. There's some couples that they might split everything like very like down the middle. I've heard of some couples that like they go to HEB and you know say like this one had $30 in groceries and this one had 70 in groceries, and then they get the receipt that start spin mowing and selling each other. Like they split things up like that, like almost like they're two separate people. Well, some people, I guess that option is there for people like that that might say like, well, I worked, they took the money out of my check the right way to where I don't owe anything, but you worked, they didn't take any money out of your check. So when it says that we owe like $10,000 to the IRS, is really mostly like your debt. If you file that return together, then both spouses will owe that $10,000. Whereas if they file separately, um, then they're able to kind of separate. There's two separate files in the IRS system. So if it's done in a way in which one spouse has no tax debt and the other one does, then they split, whether they stay married or split, whatever, that will stay attached to that taxpayer that owed it. It's more of like separating the liability. Yes, like you don't want to, for whatever reason, you don't want to like owe your spouse's liability. Or there might be cases where you can't find your spouse for some kind of reason, or y'all don't have contact with each other, and because the status that one has. One more thing I want to say about status real quick is dependent upon kind of like what your status is at the end of the year on December 31st. So if you're married on December 31st, 2025, you can file like a married tax return for the whole year, even if you didn't get married until, towards the end of the year, December, maybe you got married in December on Christmas, you can still file for like together jointly for that whole year. Or same thing, like if you got divorced, you can file single or head of household, whatever, for the whole year, even if your divorce wasn't finalized until later in the year. So it's really dependent upon what your status is on the last day of the year. Now, there's some very like extenuating circumstances where a person that's married can choose to like not file married. And they can maybe file as a single filer or head a household, in cases of what they call abandonment. I won't go into that just like right this minute, but there's are certain kind of there's allowances for you to be able to do that, possibly, depending on your circumstances. All right, I'm gonna just kind of run through this real quick. Filing requirements. So individual tax returns are due April 15th of each year. If the 15th falls like on a holiday or on a weekend, then it's often like the next business day. So some years, depending on when April 15th falls, some years it might be the taxes aren't due until April 17th. Now, some people, for whatever reason, might want to look into filing an extension. And sometimes the IRS will kind of give you like an additional 6 months, up until like October, to file your taxes. Often, you know, they'll give you like this, so that way you can avoid, because if you don't file your return, there's a penalty. And then if you don't pay your taxes, like if you owe, there's a penalty for that as well. But something important to know or be aware of is that even if you get an approved extension, like say like you get an extra six months to file the return, that does not extend the payment due date. So what that means is, if you're still kind of in the process of finalizing your return, but you know that you're probably going to end up owing like $5,000, to the IRS. If you don't pay the $5,000 by the April due date, then you'll start getting assessed penalties after like it's past due from day one. You don't get 6 extra months or whatever to like pay the debt. So oftentimes what they recommend is that you go ahead and like ensure that you have enough money withheld, taxes withheld from your checks, or if you're a business that you're been paying quarterly, or you can even send in a payment. Figure out a way like you can make a payment towards your kind of accounts to ensure that IRS at least has your money. They're holding it by the deadline or whatever. And then if you end up paying more or whatever, you can maybe get some of that refunded back to you. But if you owe money, they don't have it, you didn't pay it, they didn't receive it, then you'll be assessed like a late payment penalty, even if you have an extension. The extension just helps you avoid a late filing penalty, but not a late payment penalty. When it comes to like IRS audit selection and programs, there's different methods that they use where they'll just basically do some analytics to kind of identify returns with potential errors. In some cases, there's a computer doing this that's just kind of comparing amounts. And so, because something that one needs to understand too is that when you get your W-2 or 1099 or whatever it is from the work you've done through the year, you're receiving a copy of that as an employee, as a contractor. But oftentimes the company that's giving that to you is also sending an exact copy of that document also to the IRS. So if you got a W-2, you can't just ignore it or hide it or throw it away or shred it or whatever, thinking, oh, no one's going to know about this. The IRS already knows that you made the money because the company that paid you already gave them a copy. So be aware of that. And so if you're trying to be like, if for whatever reason, if you prepare your return and you're changing the amounts, the computer's going to match that. They're going to catch it. They're going to catch, like, if your form like if you did a job as a contractor 1099 and you got a form that says $10,000 that you earned or whatever the company paid you, that company has sent that same 1099 to the IRS with those $10,000. The IRS already knows about it. So if you're saying, no, I didn't make that much with that guy, I mean, he only paid me $5,000. There's ways to handle that dispute, but one of the ways to not do it is you don't just like do it yourself and try to like, start subtracting or reporting different amounts of what's on the form. You get to maybe go back to the company and request like a corrected form or something like that, but you can't just start saying, oh no, I'm going to start like, putting these different numbers in here because I'm gonna put the right ones per my records. You have to make sure you get the form corrected or do some kind of, make some attempt to get them corrected because otherwise IRS is gonna flag it and they're gonna get maybe a letter. And when they do audits, next topic, some of these they handle just kind of inquiries through the mail. You get a letter, they're asking you for additional information. Sometimes they'll ask you to come meet with them in the office. There's IRS offices not too far from here. I'm not sure if they're still there over by 183 and Mopac. The reason why, or 360 actually, 183 and 360. The reason why I know that is because some years, I mean like years, at least 15 probably years or so ago, a guy here in Austin got in his, it was a helicopter, was it a small plane? Either way, at the Georgetown airport and flew his plane into the IRS building here in Austin. He was mad. He owed money, I guess. Well, he said, actually, he set his house on fire first. And then he went to go fly the plane into the building. Right. He was mad at the IRS. His name was Joe Stack. I mean, you can Google it. Joe Stack, Austin, Texas. He flew his plane into the IRS building. I'm not, so they were over there. I'm not sure if they're still there, but they have offices often throughout, if you're in Austin, Houston, Dallas. So if they have questions about something that you've prepared for them or sent to them, they might ask you to come meet with us. The third type of examination is like a more of a field examination where they're going to go to your place of business where you have your records and want to do like an on-site maybe meeting, inspection, and to talk through some questions or things that they might have. Real quick, if you use like a CPA or an enrolled agent or some type of like licensed professional to prepare your taxes, they are often like recognized and allowed to help kind of represent you and help you through any type of audit kind of process, whether that's through the mail, going to the office, maybe even going up to court if you get where you have to go to before the tax court. There are tax courts with judges. If you have to go to one of these venues and you've used a licensed professional like a CPA, enrolled agent, or a lawyer is another one, then you can maybe have that individual, that professional kind of help assist you, represent you, accompany you. If you go to someone else that's not one of those licensed people, they might be able to help you with some minor kind of representation or kind of assistance, but they'll be more limited and they may not be allowed to go like in a court or a more formal setting to help you. Mm-hmm. Yep.
The responsibility of that person goes beyond just filing the taxes. This person, is it eligible by law to go and represent you and defend what he's filed for? Or do you see this would be based on an agreement between, like, I mean,
Sure. So if you have a professional that's licensed, you know, in some kind of capacity, then oftentimes, I don't know if they'll be obligated to go help you. That might be contingent upon an agreement, but they will bear some responsibility for that return as well. They have a responsibility to ensure it's correct, it's accurate. They might have some responsibility in ensuring that that if something there's because they have to abide by a code of ethics. That's another big distinction. Like when you're a licensed professional, it's often like code of ethics, and so oftentimes like just doing the right thing. Like if you made a mistake, you as a professional, an ethical professional, you should be kind of compelled to go correct it if you're truly an ethical and moral professional person, in my opinion. Whether or not you'll be actually kind of, if you're forced to or something like that, I don't know, or I mean, sorry if I'm misunderstanding the question. It's more of, I don't know if there's like something written that says like they have to go represent them. It's more like they can go. Whereas some of these other unlicensed people may not even have the option to go help. They may not even know what to do if they go before the IRS. They may not even know how to really conduct anything, or because there's oftentimes like tax concepts, vocabulary, and things that as it gets more complex and advanced, that a professional who's been trained, educated will understand and know, whereas like the everyday kind of person may not fully understand or be aware of the distinction, because there's words that in more of a just like kind of common setting that have a specific meaning, but when you get into a more professional kind of specialized setting, they might mean completely different things. So a person that doesn't have the adequate licensing and experience and training might really be just lost in helping or kind of navigating through particular matters. Yeah. Hmm. So the question is like, if the CPA files the return and then if there's issues with it, will the CPA be responsible? Maybe. It depends. The CPA or a licensed professional will be obligated to kind of do a like more of a thorough or due diligence kind of check for certain things. Now, but it doesn't rise to the level of where the CPA needs to like be like absolutely 100% sure. Like if, but they have to, it's kind of weird in a way. I mean, you should use your professional judgment, and it's kind of the requirements are in guidelines are kind of worded in a way in which you have to be kind of just professional and responsible about it, or at least have some kind of process or way that you're going to kind of go about doing your best to really help avoid those errors or identify any potential issues. So the answer really is just maybe they could like if a taxpayer tells the CPA something and the CPA is like, no, like let's not do it that way, even though that's the correct way. Let's do it this other way that's maybe not correct, or kind of like, possibly illegal. And they knowingly kind of like help make that decision to do that, then they could be responsible. They're saying, oh, you don't want to, oh man, you don't want to put all that income down because you're going to owe a lot of taxes. I want to get you a bigger refund. If they start kind of engaging those kind of immoral, kind of illegal and ethical decisions, and the CPA could be responsible for those activities. If not to the IRS, to the board or whoever issued their license. Sure.
So the CPA won't be a bit like, required to go
Mhm.
unless there's some kind of agreement of representation beforehand.
Sure. Yes. The question is like, if there's some kind of agreement or expectation for the CPA to provide representation, that will that be kind of outlined in some kind of a written agreement or letter beforehand to know kind of whether that's included in the cost or the fees and all that. Ideally, yes. Yes. Some like oftentimes, you might have a licensed professional that even maybe at no cost or very low cost might have an agreement to say like, hey, if it's a correspondence, like a letter kind of thing, then that's kind of already included in this amount without really having to stipulate that they're going to go in person and all that. But if you're going to need like advanced representation to go to meetings and all that, that may or may not be covered in your agreement with the CPA. But for basic kind of inquiries that come through the mail, oftentimes that might be included just in that rate or cost. Either way, just having a good kind of understanding of like what's all included or the expectations on both sides is really important to have. And also like it's important to be aware of that, to know that A CPA or licensed professional may not necessarily be like the lowest or cheapest option when it comes to preparing your taxes, but the benefit is that if there's any kind of issue with that return, they can or should and probably would help you kind of navigate through that, possibly at little to no cost, depending on how involved the matter is. Whereas some of the others may not even really be able to help you. Others might just kind of like, well, I just prepared your tax return, good luck. Just, have a good day. Or they might be here one day and then gone the next, especially you may not be able to find them, especially if you found someone on Facebook or something like that. And they're not licensed. Because when a CPA or whoever prepares a licensed professional, whoever prepares your return, they're going to have to put down like numbers and things and their name and title and all that on the return itself. So the IRS or whoever would know that that's who kind of helped prepare that return. And oftentimes you can even sign like a authorization to where that professional can basically respond or communicate with the IRS on your behalf, almost like an attorney. They can kind of represent you in some of these matters. The IRS was okay. Well, you're the CPA that's helping, this person out. Okay, they'll speak to you. Whereas, if you're not, they may not speak to you if you're not like a licensed professional. There are statute of limitations and things involved. Just be aware that after you file so this says here like IRS generally has 3 years to assess tax. That's if you filed the return. But there's some caveats to that. There's some things that it could be a 3-year statute of limitations. It could be a 6-year statute of limitations, or there could be just basically like no statute of limitations. Sometimes some people say so what that means is this: if I file my return, I did things right, but there's like a minor error in it, and I should have made, let's say I owed, and the error that should have been identified and corrected, it should have resulted in me owing an extra $250. If it's kind of like minor or $100, whatever, the IRS has a certain amount of time to kind of go back, identify that, and recoup it from you for those 3 years. It has to be minor though. It can't be significant. There's if the error is more than 25% of your I think it's adjusted gross income, then that they can go back maybe 6 years. If you've never filed their return, you just didn't file, then they can go back and recoup whatever money that might, or the clock doesn't really start actually until you file. In cases of straight up fraud though, they can go back. There's no statute of limitations. There is no, yeah. And those things can change. So you might be watching this, a year from now, whatever. So just be in mind, basically anything I'm saying to you, Congress can pass laws at any time, president, whoever can sign these things. So some of the stuff I'm saying right now, it could change in another year or two. So just be aware of that. This is applicable really to current today. Yes. Mhm. Will there be changes?
Yeah.
Very rarely, but that has happened where they've kind of made changes and then make it retroactive, and they try to I want to say I can't remember. I remember that happening here recently during COVID. I kind of get what you're saying. They can sometimes things like that happen. There's changes. It's rare. They usually try to make changes that are going to be forward looking or apply to the future years. But in some instances, they might go backwards and apply those changes.
That's one before. Some people they say that while currently getting more, something like that. I don't know if this is true.
No, not. I mean, not. The question is if I file early, will I get more?
Like, it's bad. Or is it control?
Just make sure. So to file early because the government has more money to. Yeah.
do it. If you are like, there's an opportunity to get more, for example, if you will get something.
No, not usually. No, that's not really a,
But it's,
no, that's not really a thing. Yeah, no, that's not really, that's not really true. Just the way I like
Okay,
that unless there's something I'm missing, that's not really the case in most instances. Whether you file now or later or February, March, April, whatever, you should get the same back. The only difference is, I wish I could remember. I'm gonna look it up later. There was something that happened, I want to say like in the past couple of years where they like January or February, they passed something and they made it like applicable to the prior tax year. So if you filed, just to kind of give people like a little bit more money, that happened maybe like I think like one time. I don't remember what it was for, sorry. But where people that filed early, um, they were looking at the potential of having to go back now and amend the return or fix it. But actually, if I remember correctly, they made the change, they made it retroactive, and they just sent the people the extra money. Like they figured it out without people having to go back and file. So what I'm saying is, it. I won't say that it never happens where they like make changes late to apply for prior years. It has happened before. Um, and that most recent instance that escapes me, they made the change kind of late. They applied it to the previous year, and they gave like the people the extra money. But there really is no benefit to doing early or late. Um, but one thing to know is that if you file, like, so if the government, if you're owed money back, if the federal government owes you money, the taxpayer, if you file late, there's no problem. So like if you know you're gonna get a refund, you're gonna get money back, and you don't do your taxes until May, June, July, August, whatever, next year, then there's no penalty. But if you wait too long, like basically 3 years is an important number to remember. If you wait more than 3 years after that tax year, whatever deadline closed, then and the government owes you money, you won't get the money. You need to do it within the 3 years. But now if you don't file, like I was saying earlier when you kind of stepped out, if you file and pay late, like if you owe the government money and you don't do your taxes till May, June, July, and you owe them money, they're gonna charge you like a late payment penalty. You can get an extension where, like I was saying, I'll just repeat one more time. You can get an extension to complete the return. That's just the paperwork to finalize it. For whatever reason, you don't have all the numbers finalized or whatever, but you kind of have an idea, a projection that you're gonna owe. Sometimes, because there's a late payment penalty, and there's also a late filing penalty. You can get an extension maybe for like 6 months to where you can avoid the late filing penalty, meaning you can get maybe to like October 15th or whatever to file. But you can really never get an extension to pay without penalty. Meaning they want their money by April 15th or whatever day it is, regardless. Even if you get the, hey, yeah, you can give us the return October, but if you end up owing money, then you have to make sure that they have it in their possession by that April 15th, whether that's you send a payment for your a big payment quarterly and then, by the date or whatever, however you pay it, just make sure that you send them the money. Otherwise you will be assessed a late payment penalty. And then something else to be aware of that I wanted to note is sometimes people kind of get like, they try to get very creative, I should say, I guess, where they think like, I've met folks that like when it's, oh, when we do the taxes, we do it this way, and then this person, puts the kids, and that one I don't, and then when we go and request maybe some kind of benefits, this person claims the kid, they start kind of moving these kids around, moving this and that, they start changing a lot of different things, or kind of like changing their circumstances on one application for one government entity and then kind of presenting it completely different over here, just be aware that the use of AI and analysis has increased. And it used to be before the current administration where there was kind of like firewalls or kind of separation between like data, like IRS wasn't necessarily sharing data with this other agency over here. They might not share as much data with each other. But here recently, it seems like all those kind of firewalls have been lifted or whatever to where you have a lot more information sharing between various agencies within the federal government or whatever other government. Like, I think it's pretty well documented, maybe that, where I wouldn't be surprised if like IRS is sharing, and there might be stories out there that IRS is sharing data with, say, Homeland Security. Or, so just be aware that you want to ensure that you're not doing things, or you're not having someone assist you that's kind of advising you to tell you, oh yeah, man, we'll do it this way on the taxes because you're going to get more money this way, this and that. I know that you're really married, but like you're, head of household and you're by yourself so you can get more money or whatever. Just be aware that there might be some analytics running in the background that might flag you, in which case then they might call you in and say, okay, you said you're a single parent with 3 kids, but we know this other person lives there with you because this other application. So just be aware that the government, whether that's the IRS or whoever, might know more about you and your situation than you realize. So it's best to always just conduct yourself in an ethical way, because IRS is one of the federal government, I think in general, is when it comes to government debts, there's powers that governments have that say like private creditors don't. Like if you owe a credit card, you don't pay it, there won't they might be more limited in what they can seize and recover from you, whereas the federal government might be able to come and seize assets that even those private companies or banks can't seize, meaning like maybe your house, your car, or whatever. So mhm.
It's
Sure,
should be like minor thing up to the like the worst case scenario.
sure.
Some people- but
The consequences of fraud. So what are some of the potential consequences of fraud when it comes to maybe like IRS and tax and all that? So like one, like I was saying a minute ago, is that IRS, the government can seize assets, properties, and things that maybe others can't. Um, you know, that's one. So they have more power to kind of seize bank accounts, maybe some of your actual personal residence or property or whatever, your automobiles. I'm not a lawyer, so don't quote, but they just know that, in general, they have more power to kind of seize things. Um, those debts don't just go away. Oftentimes they kind of just live on indefinitely until they recoup. Um, and and depending on what it is, I believe like the government really can't even forgive the debt. Or might be more limited in their ability to forgive it. Other companies, like you owe a credit card, you don't pay it, they might write it off or whatever, and it goes away. The government, it kind of just sits there until they start like kind of seizing or recouping it in some kind of way. That's one. Two is, I mean, depending on the severity of it, you could be subject to criminal prosecution. You might go to jail. There's like I believe it was Al Capone, a famous gangster. I'm pretty sure it was Al Capone back in the day, like in the 20s or 30s or back then 40s. That the government knew that he was a gangster and robbing people or shooting people or whatever, but they couldn't get him. They can ultimately the way they were able to kind of detain and arrest him was as a result of tax evasion. So he didn't go to jail for shooting, robbing, running a gang or mafia or whatever. They ended up catching him on tax like evasion charges. Now here more recently, and I'm not sure, I think this is still kind of in development, but it seems like under the current administration, When it comes to fraud, they've even been looking at ways to impact people in terms of like their status when it comes to like residency, or they're looking at ways to like denaturalize certain people. I'm not sure if that's expanded to like IRS and taxes and all that, but I know like in the case of that recent case about the Somalians in Minnesota and all that, that kind of got like a lot of publicity. And so the government now is even looking at ways to not just like arrest people and fine them or whatever, but like, oh, they might cancel your green card or might try to like just avoid. I'm not sure if they can do that. I think that's still kind of like in debate, but they're looking at ways to really like, I guess, treat people severely or harshly, depending on what it is. Mhm. What would be the process of the IRS if they were identified fraud for? So honestly, I don't know that there's like a lot of transparency on like what their methods are, in terms of oftentimes those things are kind of maintained in secrecy. Um, but it likely would start with one of those ways I was talking about, like the audits, where they like send you a letter, they tell you to come in to their office, or they might go to your place of business or possibly your residence if that for whatever reason is your place of business. So they'll go about kind of compiling things. They'll oftentimes like they may not come out and tell you you're under investigation. That's the kind of the thing. Oftentimes when it comes to kind of criminal investigations, by the time it's when they've already kind of compiled enough evidence or whatever, and they're looking to get some kind of like indictment and maybe like a warrant to arrest you. And by that time, they've already probably had like a significant amount of information. And it's at that point now that you're kind of, they often won't just tell you, oh, hey, just to give you a heads up, we're investigating you or whatever. It might be, but by the time you are aware of it, then at that point, it probably might be a pretty severe and serious thing to deal with. Yeah, they tend to be pretty kind of secretive at times about their methods of investigating. Yeah. All right. What I'm going to say here is like authorities and tax laws. The primary authorities are like, well, the Internal Revenue Code, because that's actually law, court decisions, and so things that come like from court, the Internal Revenue Code, Congress, those are all what they call like primary authorities. Secondary authorities are articles, journals, research services, that one can kind of reference, that are non-binding. They might be good to use for guidance, but you may not necessarily be able to rely upon them as like a 100% applicable interpretation that you can use legally. But yeah, that's pretty much it. When it primary and secondary sources. So when it comes down to deciding or knowing like what's the correct answer, hopefully you or the professional that you're using should be thinking about, well, what does the code say? Or if they wanted maybe like a little, just maybe not necessarily official tax law, but just kind of some best practices or whatever, they might look at like the journal or whatever, articles, something professionally produced. What you can't rely on, but people often do, is that like, well, I know that I can do this because they did it for me this way last year, or the guy down at Walmart said I can do this, or my cousin said I can do this, or my aunt's friends, brothers, sister-in-law said. Like, those are not official sources. The official sources are going to be things like the Internal Revenue Code and things that are actually produced by the IRS and the courts. Like I was saying earlier, professionals are required to abide by ethical standards and guidelines, and just exercise due diligence and do their best to ensure that the preparation is accurate and it's done with integrity and honesty. And CPAs have extensive training and licensing, unlike bookkeepers or those unlicensed professionals who might have very little, if any, requirements. I have friends that have worked for maybe some of the big franchises like tax preparation, and sometimes they may not have much more than like a high school diploma. Maybe they had a few training classes. They can kind of like know like a few things. They're relying very heavily on the software, but they may not, their understanding might be kind of limited. And that's kind of also the risk that a individual will run if they, like, if you just go yourself and buy TurboTax or one of these other softwares and start plugging numbers in yourself, depending on the situation, you could possibly make a mistake without realizing it, because oftentimes it goes beyond just plugging numbers in. There's sometimes like different rules or circumstances or things that may not be like apparent to the person preparing it. So you could end up making a mistake without even realizing it. And then before you know it, you might be getting a letter asking you a question and then if they find out that you owed, money that you should have paid, even if it wasn't fraudulent, you can say, hey, I didn't know that, I just put I uploaded my info to TurboTax and did it for me. They're gonna say, okay, we understand, we're sorry, or whatever, yada, yada, pay us. And they're gonna want their money plus the interest and all those penalties that are likely may be owed on that money. Wow, okay. Where are we at on time? Because I don't want to, are we still good on time? Okay. Because I'm about to walk through something that's a little bit more involved. So and this is just covering the individual income tax formula. And I'm going to kind of make distinctions between deductions and credits. And then we've already talked a little bit about filing statuses. Okay. So just like in a nutshell, your income tax, you'll start with your gross income. Then you subtract what they call above the line deductions to calculate your adjusted gross income. Then you have deductions that are from AGI that kind of help determine your taxable income. And then you have your tax liability plus any other taxes that might be owed. And then if you have credits, you qualify for some credits, those will be applied to your liability. And then ultimately what will result from that is whether you're receiving a refund or you owe tax. Again, a lot of this, the formula, the amounts and everything are heavily dependent upon like which tax bracket you're in, your income is in, your filing status, whether it's single, head of household, married, deductions not be available to you, and then and credits as well. So I'm going to show you the formula. Well, it's kind of visually presented here, but here we go. All right. Gross income, which is the very top box. That's the green box up there. Gross income it can be, the IRS is not limited to cash even. Sometimes you might receive some gifts or goods or services or whatever that technically are can be counted as income. If you won a prize and they've given you like a all expenses paid vacation to Cancun or wherever, even if you didn't get the money kind of directly, it potentially could be, included in your gross income. So you start with compiling all your income from whatever sources. People sometimes ask me, well, or some people think, well, I didn't put it in my taxes because it wasn't over $600 or $500, whatever. And that's not technically like the correct or lawful answer. The IRS wants you to report all your income. If you cut someone the grass in the neighborhood and they paid you $50, technically speaking, they want you to report the $50 that you made. So you pull all your income together, and then you'll subtract what they call the 4 adjusted gross income deductions. Now, there's a list of them. So let me go to that page real fast. Sorry. They're not, and not every person gets these or has these. But some do. And then the benefit of them is that you get to take them regardless of whether you do a standardized deduction or you do a itemized deduction. I'll explain just a moment what that is. So, oh, this other, sorry, I bookmarked it. I'm gonna kind of just say real quick, kind of read off what some of the 4 AGI deductions are, or might be in your case. Alimony paid. Alimony is like money that you got divorced and maybe your spouse was rich or whatever, and they're paying you money. Okay. If it was before 2019 or a certain date in 2019, then the person that's paying the alimony can possibly write that off or deduct that from their gross income. That's one thing. But if you got divorced like now and you're getting or paying alimony or whatever, there's no impact now. It's something that's kind of grandfather or something that's still kind of applicable to some people from long ago, but it's not as common for people that are maybe getting divorced today. Another 4 AGI deduction that some folks might encounter is things like health insurance deductions for self-employed taxpayers. What that is if you're a company, you have your business or whatever, and you're paying kind of health insurance premiums, then you possibly could deduct those premiums, the payments from that gross income to arrive at your adjusted gross income. Again, the biggest thing to remember here is that if you have a 4 AGI deduction, you get to deduct it and reduce your kind of income down regardless, like always. If you qualify for one of these 4 AGI deductions, you can use it. Okay. And a few others are like contributions to qualified retirement accounts, like your 401k. 1/2 of the self-employment taxes paid. Going back to what I was saying earlier, if you're self-employed, you work, you're paying income tax as well as all of the Social Security, all of the Medicare tax, like the whole 15% or whatever it was. You're able to deduct 1/2 of this from your gross income to arrive at adjusted gross income. If you can use it, you use it, it's available to you. You don't lose it, you use it, you get to. So once you kind of you start with the green box, the gross income, and then you take those 4 AGI deductions, you get to use them regardless, and you arrive at your adjusted gross income. The adjusted gross income is an important figure, okay? So even if you don't do your taxes, but it's good to have a copy and kind of look through the numbers a little bit. Again, you're responsible for them, and be familiar with your adjusted gross income, because sometimes when you apply for other things, I'm going to say like maybe like financial aid for your kid for college, or whatever, they might ask you for what's your adjusted gross income. That's not always the same as some of the other numbers we're going to walk through. It's like a specific number that is like a reference point in the return. All right, so now we're at adjusted gross income. Now, the next step is you'll subtract what they call from AGI deductions, which would be the greater of either your standard deduction. I think mine got cut off. Actually, I think it did a little bit. Sorry. It's either standard deduction or your itemized deduction. Okay. And then there's a couple of other things that maybe you can deduct as well if they apply to you. One is qualified business income. This is really applicable to maybe smaller businesses that they're able to deduct some of their business income from taxation. There's certain limitations to that. It kind of also depends on some like the trade or business that you're in, but that's available to some taxpayers. Not all, and not even everyone has a business. It's just like some business, and it's some like a portion of their income. A third one is on there is charitable contributions. This was only something that they did like for 20 and 20, right? Recently for 2021, you were able to kind of write off some of a certain amount of charitable contribution up to a certain amount if you qualified. Once you deduct all of that, you get to your taxable income, and then you multiply through those different tax rates, like those different tiers. Remember, from the 10% all the way up to 37%, and then you arrive at your tax liability. So that's your tax liability plus any other taxes you might owe. You might ask, like, what are some other taxes I might owe? Well, if for some reason, so if you're self-employed, you might owe self-employment tax there, or sometimes in some cases, weird things happen with HR. Maybe they didn't on your W-2, or it shows that you didn't pay any Social Security tax. Well, when you do your taxes, they'll calculate and say, well, Ed, we're not seeing Social Security tax paid here, so now you need to pay us that Social Security tax along with your income tax. So you arrive at your total tax, okay? And then you apply credits. What credits? It depends. It depends on there's a lot of credits out there. We could spend like another 2-3 hours just talking about different credits. Some of the more common ones are like your child tax credit. If you have a child, you get like a certain amount per child that you can apply towards your tax debt. Okay. Up until like recently, it was like about 2,000 a child. Here for 2025 though, they increased it up to 2,200 per child. So that's one of the credits. And then there's refundable and non-refundable credits, or refundable credit. Like if you have excess amount of that credit, they will refund it or give it back to you. So like if you have 2 kids, that's $4,400. If your tax bill is only $1,000, then they'll give you back the other $3,400. But there's some credits that you have that may not be refunded to you. Oftentimes you can kind of carry those forward for a certain amount of time to the next tax year. But there's credits. There's other credits. I won't walk through all of them right now, but that's the more common ones are this child tax credit, earned income credit. There might be some, actually I will talk about another. There's like dependent care credit, like if you pay for child care. There's a few, there were some like environmentally like friendly ones. But there's several credits out there. Just know that they might be available to you. And then minus any prepayments. So they'll also subtract any prepayments. So what are prepayments? It's the amounts that are withheld from your checks, your paychecks. So when you start a job, you fill out something called a W-4. They use that to kind of help project or determine how much to kind of withhold or keep from each of your checks, so that little by little, they're grabbing these amounts and they're kind of setting it aside, or sending it up to the IRS, so that it's kind of sitting there like in an account, basically, to cover the taxes that are owed for the money you've earned from check to check. If they've withheld, if you haven't had enough withheld and you don't have enough credits to kind of cover your tax liability, you're gonna likely end up owing money to the IRS. If they withheld too much, and that the withholding plus your credits ends up being more than what you owe, well, they'll refund it back to you. Sometimes, people strategically will like make it to where they have like excess money withheld because they don't want to owe, they don't want to worry about having to pay a late payment penalty or something like that. So those people, if they, even if you've given the IRS like an extra $1,000 through the year for whatever reason, you won't lose that money. They don't get to keep it. They'll refund it back to you if you want it back, when you do your return. Sometimes you have the option too of applying it to future tax years. And then quarterly payments, that's more applicable to people that have businesses. There's requirements that if you have a business, you have to like file on a quarterly basis and then send those payments according to those deadlines every 3 months. Now, there are certain penalties associated with not making like quarterly payments, or with not having enough withheld. If you don't have enough withheld, you do your taxes and you owe like a significant amount of money, usually like over 1,000 or something like that, then you can also be assessed something called an underpayment penalty. They will charge you for not paying enough through the year. So if someone says, "Oh, I'm not going to make those payments each month. I'll just pay them at the end of the year." Well, you'll end up paying them whatever you owe them. Plus, you're going to be assessed like an additional amount called an underpayment penalty. So you'll end up giving them actually extra money on top of whatever you might owe them. So ultimately, once you do these calculations and everything kind of like is calculated out, you'll arrive at whether you either a refund or an amount due. Realization and recognition. Income is realized through transactions and recognized when reported. This is, I've said a lot, so I won't get too much in that, but just know that there is a difference in between realizing income and recognizing income. Sometimes you can, depending on what the amount or the situation is, you can maybe realize the income, but then delay recognition for it. It's whenever it's like recognized, whether it determines whether or not it's going to be including income or deferred. That's some technical stuff. Just know that there is a little bit of a difference when there. And in some cases, you might be forced to like recognize income earlier than you would have liked to. Yes, in some situations, yes, but there's some concepts that come into play. Things like constructive receipts. So you can defer possibly like by delaying the closing of a sale to like the next year or whatever. But if they've sent you the check, you received the check, you basically could cash it if you want, you have access to it if you want, then you may need to like also recognize it. You may not have the option to defer. Yeah. Accounting methods and timing. There's a difference between cash and accrual. Cash is basically what all of us are as individuals. As we take cash in, cash goes out. That's kind of like our accounting method, so to speak. Accrual is a little bit more complicated or complex to explain, but it's really more applicable to businesses. When you're on accrual, you can like maybe make a sale or sell a good or whatever, and even if you haven't received the cash yet, you may be able to, or may need to recognize the sale of it. Same thing with expenses. Even if you haven't written the check to pay the light bill or the insurance of the employees, you may need to recognize those expenses earlier, even if you haven't paid, even if the money's still in your account, depending on the situation. And that's more done so that businesses don't have these huge fluctuations, and they kind of have more of a steady kind of like trend or of accounting. Because cash method, if you look at a cash method person, it could be there could be like a lot of spikes. Because you might pay all your bills in one day and then deposit all the cash like maybe once a week or once whatever. Businesses, it allows for more kind of a steady kind of flow. There's some here special doctrines, community property. Oh, one thing I want to say about Texas, and going back to the discussion about married filing joint versus married filing single. Texas, now this is not every state, but Texas is what they call a community property state. What that means is everything, when you're married here in the great state of Texas, everything that you own, earn, everything that you own, everything that you've earned, everything that you owe, like any debts, half of it belongs to your spouse. There's certain exclusions from that, but in general, so even if you were to say, oh, I'm married, I'm gonna file separately, you may need to take both of y'all's incomes and split it right down the middle to where you each report 50%, because basically half of your income belongs to your spouse and then half of their income belongs to you. And kind of everything kind of gets split down the middle. So that's another reason why in Texas, at least here, like there really isn't a monetary benefit from doing jointly versus separate. And then there's some common income exclusions that I'll just speak to quickly. There's certain things, certain gains or incomes that you can just automatically pretty much exclude them or know that they're going to be excluded from your income. Remember what I was saying earlier? Like the IRS expects you, like if you mow some grass, they want you to go report the $50, whatever you earn. But there's certain things that you can earn money from that if you make money on them, you don't necessarily have to include it, or it won't be subject to taxation. Some of those are like municipal bond interest. If you buy a bond that's issued by a municipality, like a city or something like that, any interest that you get from that bond, you likely can exclude from your income. Another thing is maybe like gifts or life insurance proceeds, or maybe if you were injured and you, like through a lawsuit got some money, some of that money might be tax-free. One of the biggest ones is sale of a home. It's not sale of any home, excuse me. We're talking a lot of guessing. It's not sale of just any home. Like if you own 10 homes and you sell them, you know, you don't get to like not pay taxes on like all of those home sales. It's like your principal residence, your primary residence. Usually the rule is like if you've lived there for 2 of the past 5 years, I believe these can change. So if that situation applies to you, it's important that anything I said really, it's kind of, I'm speaking in general here. Again, these things can change. It's important that if you have questions about anything I've said, to follow up with your specific tax professional to see what applies in your specific circumstance. So, but if you sell a home that was your primary residence for 2 of the past 5 years, and you're like an individual, a single person, you can exclude about like $250,000 of the gain on that sale. If you're a married couple, it goes up to was double. It's like $500,000. What I mean is, you buy a house in Austin. Maybe you buy one that's run down. You bought it for $100,000. You fix it up. You're living there. It's your address. It's your home. Live there for 2 years. All right. And you bought it for 100. You fix it up, put a little money in it. Maybe let's say you bought it for 100,000. You spent another 100,000 fixing it up, because that also counts. That adds to your basis. Okay. Now you pretty much, through the purchase and the investment, you have basically $200,000 in that home. And then someone comes along and says, "Hey, I want to buy that house from you. I'll give you $500,000." Okay. So then you have $200,000 in it. You're selling it to them for $500,000. If you're an individual, you'll end up, you can exclude $250,000 of the profit from the sale, and you're only going to pay or be assessed tax on the $50,000 that remains, instead of having to pay taxes on the whole amount or the whole whatever profit. If you're 2 people married, in that same scenario, you made $300,000, where you can exclude $500,000. So you will actually pay no tax, or you won't have to pay on no, you won't have to pay any tax on any of that gain or that amount. This is important to know. That way, like if you do buy a home and you're in it and it appreciates in value, and you're like, "Oh, I don't like Texas, I don't like this city, I'm gonna move or whatever." Well, if you're like at that point where if you just stay a few more months before you sell it, that might have an impact on you being able to like deduct taxes or not, or avoid taxes on part of the proceeds, where if like you are too quick or don't kind of evaluate all the different factors and consequences, and you just sell it, then you might end up costing yourself like a lot in taxes that you end up paying, that you possibly could have avoided had you just stayed there like an extra few months. Yeah. Private?
Primary
Yeah.
residence or any-
No. It only apply. The question is, does it apply to primary or any it's the primary residence. So if you buy a primary residence, you live there for 2 years, and then you sell it and you move, you want to probably try to wait to stay in the new house for like another 2 years. If you're looking, like some people kind of jump around and sell houses like regularly, they move around a lot. As long as like you're kind of spending about at least 2 years and from home to home, and then you sell it, you make profit, you oftentimes get to exclude that gain. Some people will ask me sometimes like, hey, they're doing their taxes. They say, hey, I remodeled my kitchen. Can I deduct that from my taxes? If it's your primary residence, no. If it's your personal residence, no. But the benefit is if you spend a lot, like a substantial amount of money, like improving it, like nicer, newer kitchen, nicer, newer, whatever, that will add to like what they call your basis or like your investment in the home. So that when you're calculating like your actual profit, you can kind of count that as well, to where now you might end up with a lower profit that will then maybe be under the threshold that subject to taxation. Meaning, that's what I'm talking about. Like the example of like you buy like a home, you fix it up, you put all the money you put into it to like improve it, you can deduct. That's for improvements. That's not everything. It's not a repair. Okay. There's difference between like an investment or kind of improvement kind of expense or cost versus like a repair. Like, if you make a hole in the wall for whatever reason, you fix the hole, that you can't include that maybe like in your expenses. But like if you're investing like in a whole new roof or a whole new plumbing system, sometimes or air conditioning system, you can add those to like the kind of basis or of the home. All right, that was a lot. I mean, and I probably have a lot more to cover now, but we'll kind of end it there for now. I appreciate. Wow, that was an hour. I don't think we did not think that was going to be that long at all.
But you give lots of time for
Yeah. Wow. So, well, thank y'all. Thanks to, if you have any follow-up questions, feel free to reach out to me. And then there's a card over here, with my information as well.
Provide some kind of consultation.
Yeah. So typically the way I typically work is, I work on a very, I guess, personal level where I like to understand people's kind of situations, get to know them, get to know kind of how they filed before in the past, and we kind of walk through some of the um, things that might be factors that we want to account for as we prepare their taxes. Because sometimes people will often maybe might come to me and be like, "Hey, how much do you charge?" And I really tell people it depends. It's hard for me to just to kind of say like, um, this is the amount I charge everybody. It's more like customized in a way, or more kind of, I get to know your situation. What are we looking at? Because sometimes people don't even realize, like, I'll give you an example. I've encountered people before that they're working a job. Let's just pretend like they're a teacher. Okay. They're working at the district, they teach. And then they might mention to me like, um, in our discussions, or as they're kind of walking through their activities through the year, they might say, "Oh yeah, but I was doing like Uber Eats for a little while, or I was doing DoorDash or one of the other things, delivering food." Well, they may not realize it, but they actually, by doing that, are a business. So they might have thought like, well, I'm just going to do my W-2, my individual preparation or whatever. But it's important to account for those other activities, because if you've done some work like that, there might be a form sitting sometimes like in the little portal or app or whatever you were using, waiting for you to go look at it. And people may not even know that it's there. And then if you don't account for it, including your taxes, well, you file your taxes, but then at some point in the not too distant future, you might get a letter from the IRS saying we need to talk to you, we have a question, because we see you did your taxes, you reported to us the income from your job, but then what if there's this other income that was reported to us from DoorDash or Uber or whatever that we didn't account for. So I talked to those kind of things with people to see what all they have going on. Another thing that sometimes comes up that people don't account for is like if they buy and sell crypto. If you're someone that's buying and selling Bitcoin or any Dogecoin or the Trump coin, whatever other coins, there's some tax implications maybe related to that. So we walk through those things, get to know people, and then once I kind of get a feel for what the services will be or look like, then we can start talking about maybe like pricing and all that. But then I'll do the preparation, and kind of one of my standards or responsibilities to anyone I help is that anything that I help prepare, I will stand by and share responsibility in. So if there's something that I help you with, and we get questions, we get letters or whatever, I'm gonna be there to help you out. And oftentimes, if it was something that was for whatever reason, doesn't happen often, but if let's just pretend, like say, if it was for some reason, some kind of something, just a small minor thing that on my part, I didn't catch for what I am human, I'll make it right, and that's at no additional cost or whatever. Now, if you, for whatever reason, totally didn't, share some info that we should have accounted for, I'll help you with that as well. But we might need to kind of talk about, additional services or something like that at that point. But I'm fairly accessible. I have a business phone, and I don't. I'm not kind of counting every minute and billing for every single. It's kind of like very holistic in a sense. And oftentimes I'll also be able to maybe talk to you about not just your current kind of situation or status, but things you might want to consider for the future, later this year, next year, down the road, things that you might need to kind of be aware of or account for so that you can maybe shift some of your own personal behavior to help possibly reduce your tax burden.
So do you provide discounts to students, like seniors, like certain groups?
I often do, yes. Yes. I work with people. I may not be like the cheapest, option out there. There might be some that are just doing it. I've heard of people just, people paying someone very minimal amounts, but then I look at the work that was done and it was like, whoa, they made all kinds of mistakes. And oftentimes it's like, wow, this was wrong. So sometimes the cheapest option may not be the best option for you. If you're someone that's a student, maybe like a lower income, a senior citizen kind of person that's maybe has more simple work, then I will oftentimes, just charge uh, a lesser amount. So again, this kind of goes into the whole, I kind of get to know you, talk to you, get a feel for your situation. That kind of goes along with, that customizable approach from person to person or group to group, family to family. So it's not one of those places where, oh yeah, go to this guy, you pay him $75 and he'll do it for you. Because sometimes those places that do it for that amount might be doing it completely wrong. And again, I'll just emphasize again that ultimately, bottom line, when it comes down to it, the individual is responsible for anything and everything related to their taxes. All right. Thank you all. Have a great day. Thanks to all the partners here. Ants Media and Advertising, Amplify again for allowing us to use this room, and Julinar International Education Solutions. Thank you, and we'll see you next time.
Thank you.